Would you like to invest in a company that absolutely dominates its market? Interested in knowing more about a stock that offers a yield more than 5 times higher than the S&P 500? Want to collect piles of money while you sleep? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. I want to tell you about a high-quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is selling branded tobacco products that are addictive in nature and offer incredible pricing power characteristics. The US cigarette market is slowly dying, sure. But until it completely dies, it's a cash cow. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. Best of all, the stock looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Altria Group Inc., which appear to be trading at a significant discount today. Altria Group Inc., stock ticker MO, is one of the world's largest tobacco companies. It is the largest cigarette manufacturer in the United States. Founded in 1822, Altria is now a $70 billion by market cap tobacco giant, employing more than 7,000 people. The company operates across the following subsidiaries: Philip Morris USA, U.S. Smokeless Tobacco, John Middleton, Saint Michel Wine Estates, Newmark, Nat Sherman, and Philip Morris Capital. Altria holds an approximate 10% interest in Anheuser-Busch InBev. They also own 45% of Kronos Group Inc., and they have a 35% stake in private e-cigarette maker Juul Labs Inc. U.S. tobacco sales produce most of Altria's revenue. This is despite some moderate diversification. Fiscal year 2019 revenue breaks down across the following product categories: smokable products 88%, smokeless products 9%, wine 3%, and all other less than 1%. Altria might mostly do one thing, but they do that one thing really, really well. The company's flagship U.S. cigarette brand of Marlboro has an approximate 43% share of the market. In total, Altria controls just over 50% of the U.S. cigarette market, making them the largest domestic player. They have no international cigarette sales. To give you an idea of how important Marlboro is to the company, this single brand accounted for 87% of the company's total cigarette unit sales in 2019. But even with control of the best cigarette brand, we can't ignore the elephant in the room. The obvious issue here is the secular decline of the cigarette market. There are simply less smokers today than there were 20 years ago, and it's very likely there will be even less smokers 20 years from now. But if there's one market with secular decline you'd want to be in, it's probably this one. With entrenched brands, limited competition, inelastic pricing properties, and the addictive nature of the products, it's a cash cow. That said, Altria sees the writing on the wall, and they've made some recent moves into cannabis and e-cigarettes to help future-proof the business. These moves have been disappointing, however, with Altria incurring major write-downs regarding its investments in both Kronos and Juul. Fortunately, these disappointments come with a silver lining. That silver lining is a steep drop in Altria's valuation, which has pushed up the stock's yield to stratospheric levels. To that point, the stock now yields 9%. That's more than 5 times higher than the S&P 500's yield. It's also more than 430 basis points higher than the stock's own 5-year average yield. This yield is so high that the stock can provide for an appealing total return proposition with no growth at all. I mean, we're talking about an almost 10% annual clip on just the dividend alone. That's near the long-term average annual return of the US stock market. I would go so far as to say the market is pricing in a dividend cut of some kind, but that doesn't seem to line up well with the reality of the company's finances. In fact, Altria increased the dividend in July by over 2%. They're not cutting the dividend, they're raising it. This increase made Altria good for 51 consecutive years of dividend increases. And even after the raise, the payout ratio is 78.4%, based on adjusted trailing 12 months earnings per share. Management targets a payout ratio of 80% of adjusted earnings per share. They're right in line here. Moreover, free cash flow easily covers the dividend. Recent dividend raises have slowed from the 10-year dividend growth rate of 9.7%, but I don't see a cut on the horizon. Looking at business growth, Altria increased its revenue from $16.892 billion in fiscal year 2010 to $19.796 billion in fiscal year 2019. That's a compound annual growth rate of 1.78%. Meanwhile, earnings per share expanded from $1.87 to $4.22 adjusted over this period, which is a compound annual growth rate of 9.46%. Admittedly, I did use adjusted earnings per share for fiscal year 2019. That's because of the write-downs I noted earlier. This is to more accurately reflect earnings power and growth. A combination of margin expansion and buybacks help to drive this excess bottom line growth. For perspective on the latter, the outstanding share count is down by about 10% over the last decade. Looking forward, CFRA believes Altria will compound its earnings per share at an annual rate of 5% over the next 3 years. They cite margin expansion from cost cuts, more modest volume declines, and more consumption per smoker as near-term tailwinds. Furthermore, Altria has unique pricing power properties as the largest player in a fairly fixed market with addictive products. This is all somewhat offset by the more long-term nature of the market's dynamics. It's in secular decline. That secular decline isn't as dramatic as you might think, though. It's worthwhile to point out that Altria most recently reported a 1.4% year-over-year shipment volume decrease for the first 9 months of the year for smokable products. That's an improvement relative to expectations. One wild card here is how e-cigarettes play out. Altria's write-downs on Juul have put it in the spot where it's almost all upside from here. And there's also the exclusive licensing agreement they have with Philip Morris International, Inc. to commercialize IQOS in the United States. In my view, a 5% growth rate is pretty conservative compared to Altria's long-term results, but even that would be more than enough to put together a very attractive total return picture here when you consider the yield is over 9%. If they can simply maintain the dividend and hand out low single-digit dividend raises for the next decade or two, I think that's more than enough to make this stock an appealing long-term idea. That's particularly true for income-oriented investors. Moving over to the balance sheet, this is the weakest part of the business. The balance sheet has long been just okay to me. It was a leveraged cash cow, but there's been a recent balance sheet deterioration because of the aforementioned strategic investments. The long-term debt-to-equity ratio at 4.35 is very high, but that's more because of low common equity than an extremely high debt load. Low common equity is due to a lot of treasury stock from buybacks. On the other hand, the interest coverage ratio for the last fiscal year came in at under 2, which is alarming. However, in my view, Altria's recent results are skewed and inaccurate. They've maintained at least a high single-digit interest coverage ratio over the last decade, and I see this number improving once they move past some turbulence. Profitability, unlike the balance sheet, is robust. Their main product benefits from incredibly high margins. Over the last 5 years, factoring out the most recent fiscal year, the firm has averaged annual net margin of 47.26%. and annual return on equity of 119.45%. Return on equity is obviously elevated from low common equity, so I take that with a big grain of salt. Overall, I think Altria is a very good business that has suffered from some questionable decisions over the last few years, but that has unduly punished the stock's valuation, pushing the yield up to levels that provides a compelling return all by itself. And with brand recognition, pricing power, limited competition, inelastic pricing, scale, addictive products, and huge barriers to entry, the business does have durable competitive advantages. Of course, there are risks to consider. Competition, regulation, and litigation are omnipresent risks in every industry. Litigation is a particular concern in this business, as evidenced by the Tobacco Master Settlement Agreement. However, heavy regulation limits new entrants and creates rational pricing and pricing power for the incumbents. The balance sheet has deteriorated over the last few years, limiting the company's flexibility. And while a moderate volume decline in U.S. cigarettes is expected, any acceleration in secular decline will make it difficult for the business to keep up and offset that with pricing increases and alternative product sales. The risks are sizable, but I think this stock is a very reasonable investment at the right valuation. With the stock priced at 2013 levels after a 26% drop from its 52-week high, I think the valuation is very appealing. The stock is trading hands for a price-to-earnings ratio of 8.7 based on adjusted trailing 12 months earnings per share. That's less than half of where the broader market's earnings multiple is at. It's also well off of the stock's own 5-year average price-to-earnings ratio of 17.3. Then there's cash flow, which shows a similar disconnect. The current price-to-cash flow ratio of 8.4 is almost 1/3 of its 3-year average of 21.8. And the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate due to the high yield and a long-term dividend growth rate of 2%. Longtime Altria shareholders might feel humbled and have a lump in their throat when looking at that dividend growth rate, but I think it's a reasonable expectation. Notably, this is similar to where the most recent dividend increase came in at. The business just can't keep up with the kind of growth it's produced in the past, which has caused a bit of a reset with the valuation and yield. That said, I think this reset by the market has been greatly overdone. The basic valuation metrics are severely depressed, and the yield alone can provide for a great return, even with no growth at all. As long as Altria can keep the dividend going without a cut, shareholders have a lot to look forward to at this valuation. The dividend discount model analysis gives me a fair value of $58.48. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value of money, since a dollar tomorrow is not worth the same amount as a dollar today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Altria as a 5-star stock with a fair value estimate of $54. CFRA rates Altria as a 3-star hold with a 12-month target price of $38. I came out high, albeit not too far from where Morningstar is at. Averaging the 3 numbers out gives us a final valuation of $50.16, which would indicate the stock is possibly 32% undervalued. Here's the bottom line, guys. Altria Group Inc. is a high-margin business with durable competitive advantages. While there's secular decline in its main market, that market remains a cash cow. With a 9% yield, more than 50 consecutive years of dividend raises, an on-target payout ratio, and the potential that shares are 32% undervalued, this is a compelling idea for dividend growth investors looking for yield. Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so that you don't miss out on new content. Also, take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over at Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.